Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR. Today, the great Nate Pierotti, principal at Newstack, joins us to play part interviewee and part host. Nate joined the firm as an intern in early 2020 and has quickly ascended to the principal role here at the firm. Nate was a founder prior to joining Newstack. We can dig into that a bit here today. And I'm very pleased to introduce everyone to Nate. He's been just an incredible team member, friend, and investor here at Newstack. Also going forward, Nate is going to assume the role of guest host as he interviews some of the top VCs in the business. With that, we'll kick off and learn a bit more about Nate, and then transition to a discussion about Newstack's new $42.6 million fund that we announced last month. Nate, welcome, my friend.
It's good to be here.
Yeah, this is exciting. This is a new thing for us and a bit of a role reversal. So I'm going to interview you, and then we'll turn the table. So just to start off here, Nate, what was your path to venture?
Yeah, I would say it's different than most. I'm from a small town in eastern Iowa, and to my knowledge thus far, one of the few in the industry from the state, and I take great pride in that. But I grew up not exposed to the tech industry, and I didn't know what venture capital even was until I was 21 years old. So the way I ultimately found my way into tech, though, went to engineering school. I discovered a real problem that needed solving, and I started a business around it. So my junior year in undergrad, started a business called Monarch with some great co-founders, and had the privilege of building a business alongside them for 3.5 years. And at that time, had an opportunity to exit the business, which I took, and was between, what do I want to do next? Do I want to go do another one, or do I want to join this industry that I've heard and learned about at that time, which was venture capital? And I gravitated towards that for a few reasons. I think as I developed as a founder, I love networking with other people and learning about their businesses and their models. And I'd be on Crunchbase every night looking at the recent funding rounds, asking, why did this company receive X? And what is the potential for this business? So the foundation for VC had been laid during my time as a founder, and the interest was there. So after exit, I came across the opportunity here at Newstack, and the rest is history.
We're very fortunate for it. But yeah, tell us more about Monarch. In lay terms, what was Monarch?
Yeah, I'll caveat by saying the goal was never to be a venture scale business. And at the time, my background was on athletics. I grew up playing football, different sports. I unfortunately didn't have a brother growing up. And anytime I wanted to practice, I needed someone to practice with me. And that, I think, remained dormant up until when I was in undergrad, which ignited the spark, which is my friends on the football team had a similar issue where even though they had other quarterbacks on the team that could throw them footballs and practice, they still had very little reps in their free time. And in probing a little bit deeper, I learned that the machinery they were using to practice and train was created 40 years ago. And asking myself the question, what else in sports, specifically football, hasn't evolved in 40 years? I couldn't think of a single thing. Everything has evolved so much, but the equipment that we're training these athletes with is the same and hasn't evolved for 40 years. To me, that was crazy. And going back to engineering school, I was learning about these technologies at the time that made autonomous training possible. So how do these athletes train independent of anyone else? And that was a problem that we set out to solve, which is how do you allow athletes to train on their time without anyone else's help or on anyone else's time? So what we ended up building was a combination of robotics with wearable technology. So we had this machine, and a player could wear a tracking device. They could run and perform any sort of route or drill. This machine would track them in real time and allow them to train autonomously. We would gather data from the machine and the wearable, and we'd be able to match it up together, completing the data cycle where rather than just a stream of data. You know exactly what that athlete's doing. And we would sell those to collegiate and NFL teams with the goal of eventually expanding into other sports and modernizing training equipment.
Amazing. So wide receiver is tearing down the field. Your machine can throw a ball and hit that wide receiver on the run accurately. Correct?
Yeah, correct. Yeah. I mean, it was a very challenging engineering problem to solve.
Imagine.
That was also one of the exciting reasons to go build it. It was asking myself at the time, like, what else could you go build that no one else has built before? Like today we look at these businesses and there are all sorts of analogs. Like if you're going to build a wearable on your wrist, you could look at Fitbit, you could look at Whoop, Apple Watch, all these other comps out there to understand what components are they using? How did they do this on the tech side? And what we were building at the time, it didn't have an analog. It had never been done before. And it was funny because when we were talking to customers and we would say, would you buy this or do you have these problems? They would say, that's really interesting. We just don't believe that it could be built. And we were all so excited about the opportunity to go build something that just hadn't been built before from a technical standpoint.
Crazy. I think I got a B in high school physics. So I'm glad you didn't recruit me. I think I would have been useless. But I can only imagine how complicated those 3D and 4-dimensional models, with pitch and yaw and everything else on the machine must have been.
Took a lot of minds to put together outside of just our team.
Incredible. So, how do you think being a founder has helped you in your journey so far as an investor?
Yeah, I think to be a founder and to be an investor, you need to be an optimist. And when I founded Monarch, I was very naive, but I was also very optimistic. And going through that process and, keeping that optimism high makes me optimistic whenever I'm coming across anyone with a big vision that I think is as crazy as I was when I was setting out to build a company. But more so than just optimism and being able to understand a founder's vision and get there with them and be in the same boat, rowing in the same direction, the empathy that I feel like I've developed for these founders and that I have for the founders that we've invested in is rooted in my own experience, because it's one thing to invest in these founders and it's another to have been in their shoes and experienced the highest highs and the lowest lows. And having been there before, I feel like I have true founder empathy, and I tend to be there for founders more as a person first and then an investor second. And yeah, I think that's just been tremendously helpful in helping navigate founders, provide guidance strategically, but also just having them helping them navigate the challenges that they're going to come in their personal life.
100%. There's just so many factors that can't be taught, but having gone through it, if you've got that level of crazy.
Oh yeah.
I think Charles Newhall talked about it on the show recently, founder of NEA, it takes a very unique mind to go on this journey. And if you've got one of them, I think it's probably easier to spot a like-minded individual.
Yeah, definitely. There's a radical obsession around the problem being solved and, staying up until 2 a.m., flying through emails, inbox zero every day. So yeah, look for people that have that same craziness as I do, or I did when I was a founder. And I gravitate towards it.
So does the investing scratch the itch, Nate, or are you going to jump back to the founder side one of these years?
Well, I think being a founder it's around having a builder's mindset and the achievement of something great. I believe we operate very much like a startup, which is one reason why after I started, I wanted to stay and make a career here. And it's because we operate very much like a startup. We have big, ambitious goals, and we're not afraid to talk about them and relentlessly pursue them. And that's what I get up for, right? The pursuit of something great with, someone as crazy as I am, and I would consider you that person. And that itch is scratched by that builder's mindset and that relentless pursuit of being great.
Good. Love to hear it. I want to support you in whatever endeavors you choose to pursue, Nate. But, very, very privileged and fortunate that you're working with us here. And and just doing incredible deals day in, day out, 4 of which are closing currently. So lots of activity at Newstack.
It's been a busy month.
Yes, it's a busy month. So with that, maybe we'll transition. I'll turn over the mic to you, and we can talk a bit about Fund 2, which you were very much part of the raise process and deployment.
Yeah, well, I think everyone is as excited for this as I am. But Nick, I'd love if you could go back to the beginning and take us through the thought process that led to the founding of Newstack.
I've spoken about this before on the show, right? I was kind of an independent that started investing my own money, and that led to a podcast, which led to SPVs and now a couple of funds, right? So I'm not going to go through the play-by-play on that, but you asked, about the thought process, right? And I think, if I rewind about 10 years, I started diving into venture capital like many others, and was trying to learn about this industry and the mechanics and how things worked. You're a sports guy with Monarch. Are you familiar with something called the Mendoza Line?
I've heard of the Mendoza Line, but
okay,
if you could, reacquaint me with it.
I put you on the spot. So it's sort of like the minimum bar of competency in baseball, right? In batting. So I think it's 200, right? If you bat 200, that's like the minimum to be competent, right? And if you look at the best player in baseball is probably hitting, the batting average is around 350, right? So it's an extra hit and a half for every 10 at bats. That separates the worst player in baseball from the best, right? I mean, that's not a huge gap, right, between worst and best. But the thing that stands out to me about that is they're both pretty dang low. These guys go up to the plate and they fail more than they succeed. And when I looked at venture capital, I found something quite similar, right? Historically, the loss ratio in venture is well above 50%. Even the best VCs, you and I were talking about Sequoia before and some other big names that we've been speaking with about various deals, even the best VCs fail at this most of the time. And really, most VCs only care about the $1 billion outcome, right? So when you look at it through that lens, they're often right less than 1% of the time, right? A very small fraction of a percent of the funded companies go on to achieve the outcome that aligns with the investor's objective. So it's a strange industry where failure is chronic. Now, of course, returns are asymmetric, so you make up for it on the back end with blockbuster winners. But the point stands that even those considered the best are wrong more than they're right, right? So that was kind of my first shocking observation, right? This domain of like the uber intelligent business people, they're just chronically wrong, right? And I think one explanation there, Nate, is, for me, one explanation is that building a venture scale company could be the most challenging professional endeavor in the realm of business. And maybe that high failure rate is justified. I think for me, the other explanation is that there are a lot of companies receiving funding that never should have in the first place, right? And said another way, VCs are selecting for the wrong characteristics. The variables that most VCs are selecting for very rarely map to the outcomes that they hope for. So that began sort of my deep dive, much of which was done on the podcast. I know that you've plugged into that and helped in many ways over the years on the show. But, that kind of began my journey into the science of selection. What are the myriad characteristic variables and intangibles that are both predictive and not predictive of success?
Yeah, and that's where I wanted to go next. So when you were digging into these various characteristics that you're alluding to and these success factors for these startups, what did you find, and how come investors get the picking portion wrong so frequently?
Well, I don't pretend to have all the answers, right? But I can talk through sort of the theories and discoveries that we've made, right, as a group. And it kind of, the exercise begins with, or for me, it began with looking at the failures and looking at the successes, right? So I can't remember who it was. I want to say it's CB Insights or one of those outlets, but they published a list of all the notable tech failures, well-funded companies that ultimately failed. And it was a really long list. There were hundreds of companies, but they actually had some quotes and some context and some dialogue from the founding teams. And the majority of the reasons, well, I'll ask you, this is before your time with Newstack, but what do you think made up the bulk of the reasons for failure?
Lack of focus.
Very good. I mean, that I would say was a key derivative. Most VCs are going to say, oh, it's market timing, right? But if you actually read through all these quotes and comments from the founders, it was usually running out of money, right? Or team dynamics, something on the team, some issue with the team. And the vast majority of these founders, guess what their profile read like, right? The majority were Ivy League educated or Stanford educated, right? They had worked at large tech companies and they had headquarters in San Francisco, right? So a lot of these failures had a lot of commonalities, right? They were all very well educated, San Franciscans or Silicon Valley. And, they were the common sort of tech people. And, I looked at this, I said, yes, a founder needs to be smart and they need to have access to talent and they need to have access to customers. But since when does Silicon Valley have a monopoly on business builders, right? That just never resonated with me. Of course, there's a lot of tech talent and there's a lot of capital, but that alone doesn't create a remarkable business builder, right? Just because you're located in a region and you work for a company, that doesn't make you great, right?
Yeah.
So, I looked at the successes too, Nate, and my personal heroes, right? I tried not to look at too many modern examples because, we'll see if those stand the test of time. But when you look at the historical examples, like my heroes were Rockefeller and Ford and Edison and Disney and Sam Walton, right? None of those guys were Ivy League educated, right? None of those guys, of course, were in San Francisco. That was kind of before, the big surge in tech there, of course. But when you look at these folks, there are commonalities between them, right? They all have an unquenchable thirst for success. They all have unbridled obsession with making things work. None of them let capital get in the way of success. They all ran, like if you read the biographies, they were running out of money. They were raising money. They were hand to mouth. I mean, there were successes, failures. They almost got shut down at various times. These guys fought, persisted, right? Team dynamics? You want to ask Rockefeller if team dynamics got in the way of success? Are you kidding me? Like, these guys aren't going to let team dynamics get in the way of success. They found a way. And they had, if you've read the biographies, there were plenty of problems with different stakeholders and team members and whatnot, but they persisted, right? So it's, for me, the quantum unit of success in business is mindset and motor, continuous forward momentum at any cost. And this is not something that jumps off the page of a pitch deck or a LinkedIn profile, right? It requires real face-to-face connection. And importantly, the ability to spot greatness when it's staring you in the face. It remains to be seen if we're one of the firms that can truly spot the greats. But first, you have to start with a thesis. And the thesis is your education and your work experience does not make you one of the greats, right? It's really your mindset and your motor. And so that's kind of where we began as a firm, and that's what we look for.
How do you vet for motor and how do you vet for mindset?
Well, you do it all the time. I should ask you.
Well, I feel like I might have part of the answer key over here, but I'm sure that the audience is asking themselves that right now. So if you could reveal, I guess, what we look for. in terms of vetting for those characteristics?
The truth is we can't come to a conclusive decision on those things in a very short amount of time, but we can certainly filter out the ones that we don't think are going to reach the bar, and we can get, I think, good insight into people that have the potential for it or may have the it factor, as we call it, right? And so I think, you and I will utilize a lot of little tips and tricks and tactics to kind of pressure test founders and their level of commitment and their level of obsession. A funny example, one of our founders, Tarek over at Fair Market, he was hiring sales leaders, and he would intentionally send them an invite, I think, for like 6 a.m. on a Saturday. Which I think is,
that.
We don't do that specifically, but it's a funny way for him to test, is somebody committed enough to show up to an interview at 6 a.m. on a Saturday morning, right? Obviously, that's, for a sales role. So we're talking about founders here, but there are a variety of ways that we can get a sense for somebody's unbridled, obsessive nature. Right? The mindset of failure is not an option and forward momentum at all costs. Right? And so in a way, we know how we operate. And if a founder can't operate at the speed and agility and momentum as the venture capitalist, then we're way upside down. Right? The founders need to be at a higher level than us. Right? The true greats. So there's a variety of tips and tricks, and then we try and quantify it. As you know, Nate, like we will take our key factors. I think we've got 7 on the founder side that we think are necessary for success, and we'll put them on a scale, 50th percentile to 99th, with very specific definitions of each, and have a pretty candid conversation about, where we see the strengths and where we see the gaps.
100%. And it's a unique process, but big believer in that it helps us identify those that have the it factor, as we call it.
We'll tell you in 10 years, Nate.
Don't hold your breath.
I'll say this, Nate, though, like this is what makes it so fun to work with you and to work with the founders that we invest in, because it's delightful working with people that inspire you every day with their commitment and how resourceful and how they turn bad situations to good, how they turn no's to yeses, right? How they close massive enterprise contracts when, they got 3 months of runway and the customer doesn't know the wiser. I mean, it's miracles happen, business miracles, right? But it's just a fun thing to be a part of if you select the right partners that are true fit with your mindset as a firm.
It's the best part of the job. I was asked by someone recently, what's your favorite part of being an investor? And it's all about the people, right? Like working with people that are just getting after it. They're teaching you things, which is always interesting. And they're running 110 miles an hour the way that we do as a firm. And when you find those people, being able to adding them into the portfolio and working with them on a week-to-week, month-to-month basis, I mean, that's what it's all about.
100%. That's why we don't work. We have fun.
Yeah, right?
We get tired, but it's a lot of fun.
Yeah. I want to talk about Fund 1 and Fund 2 in a minute here, but prior to diving in and talking about the tactics and the strategy, I want to hear from the horse's mouth about the vision and the end goal for what you wanted the firm to become and why that was so important to you.
Well, we have this thesis and this tagline of investing in outsiders, right? I think the conversation we just had sort of illuminates that thesis and why it is the thesis. We are outsiders. You went to Iowa. I went to Indiana, right? Neither of us worked for a tier 1 VC before this, and neither of us had a $1 billion exit, with some startup, even though we've both built amazing products and companies. And because of that, it gives us some insight into some other folks that maybe don't have the shiny resumes and all the pedigree and the provenance to go out and raise a $10 million seed round at a $100 million post, right? Like, I'm still baffled at how that can happen, but it's nice that, we're a group of outsiders that are pretty committed to what we're trying to do. We get to empower founders to achieve their life's greatest professional ambition. I mean, that is a remarkable thing to do. And many of these founders in Phoenix or Atlanta or Minneapolis or St. Louis or Chicago, they just don't have access to capital at the early stages, right? When all the proof points aren't there, when they don't have the traction and they don't have these bright, shiny resumes, they can't access money. And it's a perfect fit for us, right? We don't need to see traction. We need to see mindset, right? And we look for proof points of progress, of course, but it doesn't have to show up in the ARR for us to act. So when I think about the vision for the firm, I think there's a huge opportunity between the coasts. I mean, you and I kind of strategize about this a lot, and it's a lot of fun to kind of think through, how we can try and match the level of our founders in our endeavor to build this great firm and become the de facto standard between the coasts, right? We want every founder that's building a business outside of the Valley in New York to be thinking, my goodness, I would love to have NewStack involved, right? And it's a challenge, and every great thing in life is. But, I think we've put some good pieces together, and we got a real shot.
Couldn't agree more. So we're going to talk about Fund 2. I want to talk about Fund 1, which kicked off in 2018. How big was Fund 1? What was the objective for the fund? And how did that lay the foundation for subsequent funds?
I have relationships with many emerging managers, right? Folks that have listened to the show over the years, or, we've met at various events, and they will often ask, for input on Fund 1 and what they should be thinking about and the strategy. And the reality of the matter is, Nate, Fund 1 is about getting in business, right? You got to put together enough capital to have some portfolio theory and strategy, some portfolio construction, be able to do enough deals that you can do some good deals, and, try and scratch out as much ownership as you can, right? So with any fund and with any professional firm, we're trying to build a legacy institutional firm here, not just, hang a shingle and be in business as VCs, as so many zombie firms have become. But you got to do a few things, right? You got to prove you can do good deals. You got to pick good deals, right? Which is a function of access and selection. Number 2, you got to get ownership, right? If you don't get enough ownership in these deals, then you're not going to have portfolio returns. It's critical. So ownership at entry with first check. And then 3rd, you need to prove you can get ownership at exit, right? So that's kind of a function of reserves and pro ratas, and who do you double down on, and which companies do you not reinvest in. So those 3 things are kind of the archetype I've used for the firm. First and foremost, just getting great deals and getting business, right? Number 2, get your ownership at entry. And number 3, prove you can get ownership at exit. So with Fund 1, we had to get in business and we had to select good deals. And I think fortunately for us, we've had a lot of good luck since the beginning, and that helped us in our mission on Fund 2. Hopefully the luck continues, but we were fortunate to make some good picks, I think. And we couldn't prove number 2 with Fund 1, ownership. We did some creative tactics to increase our ownership. Happy to talk about those. But now we're moving on with a proper fund. We have a proper vehicle, $42.6 million, and we can do 1 and 2 now with Fund 2.
And with Fund 2, like you said, $42.6 million, recently announced a couple months ago. What was the goal for Fund 2, and what was the biggest objection that you received from LPs when sizing up?
Yeah, I think, we want to build a firm here. And in order to do that, we need more talent and we need the ability to lead deals and do enough of them to provide the appropriate level of diversification for the stage we're investing, right? We're investing in a very risky asset class. We covered this before. More of these things go the wrong way than go the right way. Even though loss ratios are dropping, still the majority of these things are not going to go to $1 billion, right? Not even a fraction. And so, so we've got to do great investments. We're trying to do 35 of those. Average check size is $1 million at entry. And we tend to get double-digit ownership. So we got to lead and co-lead these deals, which is a big distinction, right? Leading deals is a whole different business than co-investing in deals in venture capital. It's similar to the delta between being a VC and being an angel, right? All three are very different businesses: leading deals, co-investing in deals, being an angel investor. And with this fund, we're co-leading and leading every deal, right? We have some exceptions and stuff, but in general, our philosophy is leading deals. So we got to do that, and we got to prove real performance. We got to put together a track record, right? Because there's a lot of LPs out there that need to see proof. They need certain proof points in order to commit. I mean, I remember having a conversation with a friend of mine, a limited partner, institutional limited partner, during the pre-raise of Fund 2, and he said, "Nick, you're not going to raise institutional capital." And I said, "Watch me." I'm going to go out and I'm going to raise institutional dollars. The truth of the matter was he was right. And he had reasons. He said, "Look, the track record is good. It's one of the stronger ones I've seen this quarter." These were his words, but it's early. It's not fully baked. We need to see more B rounds and C rounds to get institutional backing, or you need to be a spin out, right? Most of your peers that are having success raising $40, $50 million funds have spun out of a large brand and can point to attribution and can show that, they've had proper training, by a big firm. You don't have that. And without, being a spin out and without a mature track record, institutions are just not going to pull the trigger on you because it's too hard for them to underwrite the risk. Well, I was stubborn. And so I went out and I pitched a lot of institutions. And you know how many I converted?
Well, I'm guessing 0.
Well, right? Because you were there. We did not convert institutions on this fund. And that was a disappointment. But on the other hand, we had a lot of success with some other key partners, a couple strategic partners, a lot of family offices, and some high net worth individuals. So the pitch worked. It didn't fall on deaf ears, but our ICP, so to speak, ideal customer persona, it was mostly stubbornness on my part, but I should have opened my ears and listened a little more and put more effort into the beachhead customer segment that was a better fit for that fund. The good news is, though, that we've laid the groundwork with a lot of institutions that are reaching out with frequency to get updates and hear how things are going. So it didn't work, but it worked in that, now we have an opportunity to build relationships with those people and build confidence over time as we prep for Fund 3.
And when you're in the pre-raise process and you're socializing this step up from 6 to 40 million with the objective of getting higher ownership, how do you convince LPs that you can do this, that you can get in early with ownership, be the primary partner, if we haven't had a big track record of doing so?
That's the question, right? And it was tricky. I think when we first scoped out Fund 2, about midway through Fund 1, JR tells me, so JR is our COO here, right? He's been around since the beginning. He tells me that on the whiteboard, we put 25 million up on the big board. And that was the goal. And the venture partner that was in the room at the time, his jaw hit the table and he said, "No way are we going to step up, 4x the fund size." Because Fund 1 was 6 million and change, right? And, that grew over time. And part of the reason that target grew, and we ended up, having a wild, ambitious target, kind of a reach stretch goal of 50 million, hoping to get to 30, right? And kind of having a wild stretch of 50. But the reason we did that is really portfolio construction, right? So we talked about this before, Nate, but it's important to select good deals, but it's also important to lead deals. And we had two choices. We either take smaller ownership stakes and we don't lead everything, or we do less deals, right? So instead of 35, maybe we do 20, 25. The problem with doing 20, 25 deals at pre-seed and seed, that's a suspect product that you're offering to your LPs. In my opinion, as a fiduciary, with the failure rates in the industry, I mean, you could be really dang good, but remember that Mendoza line, like the gap between average, competent, and the best in the industry is pretty narrow. And you really have to hope that you get some blockbuster successes to, cover all the sins in the portfolio. And when you're doing pre-seed investing, it's a big risk, to assume you're going to get a multi-billion-dollar outcome. That's, pretty speculative. So we didn't want to do 20, 25 investments. We wanted to provide appropriate diversification, which meant we were going to have to sacrifice significantly on leading deals and getting ownership in order to reach that 35 number. So we had to take up the target, and we just had to say, I mean, obviously there's some stubbornness here. We like to say about the founders, we love founders that are super stubborn about the vision, but flexible about the path to get there. I think we've been really stubborn about the number. We got to get over 30, way better if we get to 40, and a dream to get to 50 for this fund. The path to get there was not the path I thought it would be, right? We ended up converting a lot more investors. I mean, we have around 100 investors in this fund. Some of my peers have 10, 12, 15, 20, right? It's a whole different LP makeup. But we achieved the goal, and now that allows us to do a proper strategy. We can do 35 deals, and we can lead all of them or co-lead, most of them, and get double-digit ownership.
You talked about the path and how it winded quite a bit. The strategy may have changed. Maybe not the strategy, but the tactics may have changed. Can you share more on the path from pre-raise, going to market, and what led up to first close?
Yeah, so for us, the pre-raise, I think I spent maybe 8 months on the pre-raise process. It's not something everyone does now, but historically, that was a really important part of the process. You got to start socializing what you're thinking about, and you got to get feedback on it, right? Feedback on thesis, what's resonating, what doesn't, feedback on your pitch deck, feedback on portfolio construction, fees, reserve strategy, right? There's a lot of components here that it's really difficult, especially as a single GP. I mean, we've had a lot of team help and people that have leveled up to extreme levels at Newstack. But, back in the day, solo GP trying to put together this strategy, if I did it just with the whiteboard, in the room with a couple folks, we would have made some bad decisions. But, I spent a lot of time with other GPs during the pre-raise, and then LPs that I respect, that have been big supporters of ours and the show for many years, and got a lot of feedback. It also helps to have mentors and advocates, right? So all these pre-raise discussions, these people are going to help you if they like you and support what you're trying to do. When you actually go out for the raise, they can help with networking, and they can help you navigate a tricky close process, right? They can give you tips on sales, right? Not every venture capitalist is built to sell. I certainly wasn't. Sales is not my strength, right? I'd like to think analysis and trying to spot greatness when it's in front of you and run a really great diligence process. I'd like to think that's the strength. But if you want to be successful as a VC, you can't just focus on your strengths. You got to fill out a lot of different skill sets over time. So that was the pre-raise process. And then what was the second part of your question, Nate?
Yeah, leading up to first close, how did the tactics change from what you expected going into dialing for dollars to actually gearing up for first close and gaining your first commitments?
Yeah. Well, I mean, I'll give you an example of a mistake we made tactically during the pre-raise. So part of the pre-raise effort was also sort of emboldening and activating our existing LP base. So we had, I think, 42 LPs on Fund 1. Small fund, $6 million and change, but 42 LPs. And you got to go out to that LP base and hopefully you level them up, right? Most fund managers will tell you if you get to 2x in dollar commitments of your existing LP base, you're winning, right? So if you did a $10 million fund, if the existing LP base gets you to 20, then that looks great, right? JR here, he kind of runs investor relations, but he had at the time more limited interaction with the limited partners. And our strategy was, hey, JR, why don't you call everyone and feel them out, see where they're at and what they want to commit to the next fund. And do they have some friends that they can link us up with? And then I would go out and focus on all new prospects. So that's kind of how we divided and conquered, right? And, some of the LPs, notably like our biggest LP on Fund 1, our anchor, he wasn't super pleased that I didn't give him a call, And since that time, JR has grown the depth of his relationships with all our LPs because he has regular interaction with them now. But at the time, that IR was kind of investor relations was a new role for him. And so we got to know from our biggest anchor during the pre-raise process, feeling him out and his temperature on, coming in at first close, we got to know a 0. And that was problematic because, he was great LP and had a great network of other LPs that he kind of brought with him. And so, that was my time to turn a no into a yes. We've talked about that with our founders, but, I was on the spot. And so I remember scheduling a call on a Saturday with that LP and his cohort of friends. And we turned that no into a yes. And he came in a big way for Fund 2. But that was a lesson. This is a relationship game. And, I made a mistake of neglecting to a certain degree that relationship. And it was a really important one.
Mm-hmm.
So there was a lessons learned during the pre-raise.
Would you say that was the biggest lesson that you learned, or in hindsight, if you could go back to the pre-raise process, what would you have told yourself, or what it's a piece of advice that you would give yourself now looking back?
Well, I think you need to know yourself, right? Your own thesis, your own differentiation. You need to know your target. We talked about this before, the ICP, right? And you got to pre-qualify, right? Like fill the top of funnel, but then pre-qualify. Otherwise, you end up kissing a ton of frogs. Like we've gone through this exercise with founders where we'll just take a lot of meetings. And then you find out in the first 5 minutes of the meeting, oh, I shouldn't be meeting with this. It's off thesis or, or it's just not something we would do, right? Most of what we do is B2B SaaS. This is, maybe a D2C company that's in San Francisco. Like that's not what we should be focused on. And, I was all about kind of top of funnel and just taking action. It's kind of that aim, fire, ready methodology. And there's a lot of good in that, right? A bias for action and forward momentum. But the pre-raise process is a strategic exercise to get things right. Mm-hmm. And if I could go back and do it again, I'd spend more time on making sure our thesis, was clear and differentiated, which I think we actually did a good job with. But defining the target better and pre-qualifying those targets as they came in, right?
So how many meetings would you say you took through the duration of the fundraise, if you recall?
Well, for the CRM, we use Streak, and the total number of contacts in Streak is 505. I thought it was in the 400s. So this is just the pipeline for Fund 2. That is a combination of real targets, so qualified LPs. It also includes what I refer to as gatekeepers, both passive and active gatekeepers. So those are friends that can be helpful and can make introductions, but aren't a LP target themselves. So if we had 500 targets in the system, I took that many meetings.
At least. And
I would say on average, it was probably, for the LPs that converted, it was probably 3 meetings would be the average, I would guess, for those that converted. So you do the math. I mean, we had 100-ish commits on Fund 2. If each of those took 3 meetings, that's 300 right there, plus the other 400 people I met with. So maybe 700 meetings, maybe more.
On top of everything else, too. That's on top of running the firm.
Well, thank God we've got a team, right, that could do that while I was delinquent and negligent running around trying to raise money.
Yeah, I learned a lot during that time.
Yes, sir, you did.
So how do you, leading up to first close, how big was the first close, first off?
I think we did first close around 12 million is my recollection.
Okay. 12 million. How do you go about breeding urgency for first close when so many LPs can just wait for a final close? How do you get people to commit?
I mean, if you got the answer to that question, I'd love to hear it. It's difficult, right? So first close, we got to 12. So Fund 1 was 6. We got the existing LP base to 12 for first close. And then ultimately we got the existing LP base up to 18, I believe. Combination of after first close. So we about 3x Fund 1 LPs, I think. As far as the urgency piece, the obvious one that we used and most people use is you raise the minimums over time, right? So we started out with 250,000 minimums, I believe. And, progressively you have a certain number of slots you can fill at that, or you just put a timeline around it. So you say, after this date, after December, the minimums jump to 500. And so you try and create urgency around a deadline there. And, sophisticated LPs that have been at this a long time, they'll call you out. They'll say, is there anything that's structurally that requires you to raise the minimums at this point? And the answer is no for us in that case. So, in rare cases, you admit LPs, they come in a little late, but they want to come in at the original minimum, and you got to make judgment calls. In general, you stick to your guns, but you make some exceptions here and there if it's an important LP with an important network. So that was the primary thing we did, was raising minimums.
Got it. And how did the tactics change post first close ahead of the final close?
Tactics like fundraising and sales tactics?
Yeah, whatever comes to mind. How did, either strategically or tactically, what were the changes? Did you change your approach, who you're talking to? I mean, you talked about upping the minimums, but was there anything else that you did to close the remainder? I mean, 30 million. I mean, there's still 30 million to raise after that point. I'm curious what changed from that first close up to the final close. I'm sure track record was a part of it, if you want to speak to that, but it's a big jump.
Yeah, it was a big jump. So, I mean, there were some desperate moments, and, there was a lot of hope and a lot of commitment to making it happen. Some valuable things we did, you recognize you have to have top of funnel, right? You have to have targets to meet with and pitch. And like we discussed before, you got to pre-qualify those so you're not wasting your time. But something we did is we implemented daily meetings, with our analyst here, Zeke. And he was kind of my co-pilot on the funnel. And there's a couple ways we approached it, but LinkedIn was a valuable tool. But you take all these folks in your network that we identify them as key allies, and there's two ways you can utilize your network. You either take a key ally and you go and look through all their LinkedIn connections to see anyone that smells like, looks like, feels like they could be a family office, a high net worth, an institutional LP. And then you reach out to them and say, hey, we came across these 5 folks or these 8 folks. Are you close enough with anyone that you'd be willing to reach out on our behalf for an introduction, right? Mm-hmm. That's one way. And then the other way is you identify the targets that you're going after. If you can, right? Family offices are often intentionally mysterious and hidden and don't want to be found, right? Unless it's the perfect referral, from the right person. So some of these targets are mysterious, right? It's not like an enterprise SaaS startup focused on procurement where you can identify all the decision makers you want, VP of procurement or sustainability or operations, and you can go out and target everyone you want. In this industry, a lot of the targets don't have a title that's common and homogenous, and they're hard to find. So that other method is really, if you can find the targets, institutional targets are the easiest to find. Then you can look at them and see your common connections, right? How many connections do you have in common? And are any of those a really strong ally of yours? And then you reach out that way. But I would do daily meetings with Zeke to go through, different allies, because we had a list of hundreds of different allies. And one by one, we kind of pick them off and say, who's the list that we can send to this group, and request, strong introductions. So that was something we did and shook a lot of trees, Nate. I mean, we filled a pipeline doing that. Took a lot of work and a lot of effort, but it paid off. We got a lot of really high quality referrals and introductions. Aside from that, I think the other primary motivating factor during the raise was the progress of the portfolio, right? So you're doing deals, Austin's doing deals, I'm doing deals, but the reason you do a first close is because you got to start deploying, right? And as you deploy, you get in some good logos and you can market those. The LPs are often more excited about talking about the companies than they are talking about the VC firm, right? Because the companies are doing all sorts of interesting things. VCs, tend to be a dime a dozen. So strategies are a little less unique. And so as we started doing deals, that became great collateral. I don't know if you remember putting together like sort of a white paper, that described each company and potential exit outcomes. And then the markups came quick, right? We had a couple blockbusters early. I think our third investment, we did a pre-seed round. We let it, got strong ownership. And then within 7 months, they were closing a Series A from Insight at a 65 post. And we were close to a 10x multiple on that one. And we had a few others that just popped really quick. And they weren't hype investments. They were real material revenue growth, great net revenue retention, strong expansion revenue. These were fundamentally great businesses without the pedigree, without the flash, without the hype, that raised at huge material gains, big up rounds, and that helped a lot.
And they were true to thesis, right? Like how many times do we see fund managers go out, put together a fund, and they're promising one thing to LPs, and the construction of the portfolio after the deployment period looks entirely different.
Yeah. Well, I can't speak for everyone else, but I know they're out there. People are.
We've heard stories.
Yes.
We can leave it at that.
Yeah. Yeah. We've been banging on thesis, right? Mostly B2B SaaS, outsider profiles, and we get in. I think our average pre-money is around 4.5 would be my guess historically, somewhere in that neighborhood. So we get in really early. And this is a game about, assets and pricing. Price at entry and price at exit. Those are the two things that matter. And that's how you deliver returns. And if you're just a price taker and you're not thinking about the former, right, you're leaving money on the table, even with successes, right? Mm-hmm. You're leaving money on the table. And it's a really important thing that we think about. And it's an important part of what we do because it has a ripple effect on the entire strategy.
Yeah, I mean, those margins add up, paying a little bit more, even if it's 20% more for a startup. If you're getting that ownership, your check size is increasing 20%. You do that enough, all of a sudden you're investing in 20% fewer companies and you're 20% less diversified at the end of the fund.
That's exactly right. I think that's what a lot of folks miss, right? As they go into sort of institutional VC management, is if your strategy is structured on ownership. Right? If ownership is a really important variable to you, which it is to the LPs, I guarantee it. So if you're not thinking about ownership, it could be an issue. But if ownership is central to the strategy, then if you're paying up for deals, right? If you say our average post is going to be 10 and your average post is 20, you got to pay you got to cut a much bigger check in order to get your ownership, right? And the result of that is just what you said. You end up doing a lot less deals, right? Mm-hmm. So you're either going to compromise on your ownership, which means you're likely not going to have portfolio returners, or you do a lot less deals and you don't have nearly as many at-bats to hit some of those out of the park.
Yeah. I mean, I saw firsthand how difficult this fundraise was and the strain it put on you, the entire team. If you're being candid with the audience, though, give us one of the toughest times during the fundraise that you can recall.
Oh, it was a piece of cake. Are you kidding?
Sounds like it.
It was a difficult day when our anchor check from Fund 1 delivered a no. It was a good day when that no became a yes. Another difficult day was our anchor target investor. I mean, we hit it off. The first meeting I had with this guy, it was, it was like a great first date. I can't think of a better analogy. We were just in sync. It was an amazing meeting. And this is a guy that, minimum check probably would have been $5 million. I mean, he was an anchor target, and he had anchored another firm. And the best thing is that he built a firm in a different industry that had almost the same tenets as us, right? Actually, a friend of the firm recently said this, Rami Adib at 1984. He recently said to me on a call, he's like, "You're the Moneyball firm." And I had never kind of put two and two together, but he's like, you find all these intangible values that really lead to success, right? It's not the big, strong 6'5" guy with the square jaw and has 5 tools that, is the most successful baseball player. It's, maybe it's the guy that's a little overweight and has, a funny throwing motion or whatever it is. And I thought it was really kind of him, to make that analogy. And when I was talking with this anchor LP candidate, he had applied a very similar methodology in a completely different financial context. And it was transformational. That's how he built his firm. And he saw all these elements. So, you kind of mind meld sometimes with founders. We kind of had that and we're just going back and forth. And I remember getting off the phone and telling my wife, I think we found our anchor. Like, I was delighted, only to jump on a call with him 2 days later. And he said, yeah, I'm going to sit this out. And it's going to be a no. And he had, committed to another VC fund, I think 4 or 5 months prior. And he just thought, in general, he had a VC fund and, we were differentiated and really interesting, but, he had already kind of checked that box. And that was pretty deflating. And I remember having that conversation with him. And I said, "Sir, let's let this be a not right now and not a no. Let's keep in touch. because it's going to take us a while to raise this thing. And I'd love to learn from you and build this relationship over time. And he said, okay, that makes sense. And 8 months later, it took us 8 months, but 8 months later, he became, our anchor investor. But it was tough to him.
It's just a testament that there's multiple paths, right? Like you easily could have thrown a fit and said, F you and let that be the end of it, right? But like going back to what we were talking about at the top of the call, it's like having that fire and that mindset of just, you're going to grind through it. You're going to break through walls. You're going to turn no's to yeses. This is how it manifests on the venture side.
It's the best thing about a no is that any answer is actually a good answer. A yes is amazing, and a no is fuel.
Mm-hmm.
It really is. And it took me a while to figure out that mindset. I've been at this almost 10 years now, and the no's stung early on, but we really weren't worthy of big yeses, and back in 2015 and stuff, I mean, we're still getting our footing as a firm, figuring out our strategy.
Mm-hmm.
And, over time, the no's just began to feel good because it was fuel. It's like, well, I can either prove you wrong or I can get you to come around. And both of those, in my mind, are, challenges, worthy challenges. So, yeah, the no's sting a little bit, but it's always an opportunity.
It makes the successes feel that much sweeter, right?
Yeah, that's right. Hey, Nate, I remember when you were thinking about joining us in an internship role, right? You're a principal. When you first joined in an internship role, you started vetting us after we gave you the offer. Remember, you pinging me on nights and weekends and at strange times, and I was responding to you, and you had a tough choice, right? How do you go from CEO of a funded company that's been successful to an internship role, bottom of the totem pole, at a firm that at the time, we had $6 million under management in a blind pool plus some SPVs, but this was not a sure thing that we were going to be able to level up, to sort of a proper fund. So I'm really glad we got you.
I'm really glad I joined. I think the key is not thinking too short-sighted, right? Joining as an unpaid intern, that's a portion of the story. And if you plan on sticking around for a long time, it ends up being a minor percentage of that overall story. And it also made it that much sweeter. I remember starting, and I don't think any intern had joined full time. And I said, I'm going to be the first. And it worked out, fortunately. But I think part of it is believing in the upside, but also the team, right? Like the best part is working with other killers. And I think when I had the opportunity to meet you, I was like, this is my type of guy, and we're going to build something.
It was a strange time, beginning of the pandemic, but I'm sure as heck glad you didn't say no, because I would have showed up on your doorstep in Dubuque, Iowa. And the no, I would have been hell bent on making the no a yes. We've got some stories like that with founders too. We don't have to tell them today, but tough deals to get into. You better get on a plane and get out there and make it happen, right?
Turn no's to yeses.
That's right.
I mean, there's always a path, right? Just because whatever you're coming across in that moment in time, find a solution, figure it out, be resourceful, get creative.
That's right.
I mean, to your point, we could rehash probably another hour about all the stories we've had together and how we've gotten our way into some deals, but it's also a fun part of the job.
It's a fun part of it, especially when you get the fit right. Because if you go above and beyond and it's the right partnership fit with the founder is just going to go, all right, let's do this.
Yeah.
In most cases.
Because they can feel it too. They can feel it too. They don't want someone that's going to take the quick no. They want to feel like if you have that fire and we're able to show that, or the founder has that fire and we're able to show that, they're like, okay, these guys are my type of guys. And they want to be associated with us as much as we want to be associated with them.
100%. And the founders were very helpful during the fundraise too. I mean, for networking and connections, they've seen us build from nothing right? You said this at the top, but we're more of a startup. We happen to be in the financial services industry and supporting founders and deploying capital, but it's a startup and the founders feel it and they've known it from the beginning. And it's part of what kind of makes the relationship so special because we've grown up together as companies.
Mm-hmm. All these war stories are running through my mind right now, and I'd love to rehash them all.
We'll have to do another reverse interview where I'll do you and get all your input on the first couple of years of NewStack.
I think so. I want to turn our attention back to the fundraise and leading up to the final close. Some fund managers have said the majority of capital comes in the last 2 weeks of the raise. Was this the case in your experience, or what transpired the last few weeks?
For us, I think it was the last couple months. Certainly the last few weeks, a lot of those commitments landed because people need a deadline. At the end of the day, you need a deadline. It's not like a startup financing where there's clearly a firm deadline and a close date, at least if you're doing a price round. With this, you had to give people a deadline. But it was those last few months that things really came together and we set the close date. So Nate, you remember this, but we held our sort of LP summit and it was at a suspect time because Delta hit and our top 10, I don't know if you remember this, but our top 10 limited partner prospects all canceled, right? Mm-hmm. They had committed to coming. And I even had like 5 of them participating on a panel at the summit and our top 10 canceled, right? Number 11 came and we ended up closing number 11. I think it was a $2 million check, but that was a tough time, right? Because let a lot of air out of the system. And we had a wonderful summit, very successful summit with a lot of great people that showed up, mostly local. And that kind of catalyzed a lot of conversations, right? So we have this big event, LPs bring their friends, and then that kind of sets up some coffee meetings and some Zoom meetings thereafter. And that allowed us to set the final close. I think it was when I had 40 or 50 LPs in the diligence, interest, cultivation phase of the funnel. When I had that number and the aggregate, amount of those commitments, estimated commitments was another 20 million or so. That's when we set the final close and we said, we're going to give ourselves 8 more weeks, I think it was, and push to the finish and, try and convert as many of these prospects as possible. Those were all people we had actually done a meeting with, right? If they were in the diligence phase for us, we had done at least one meeting with them. And I felt like, that was our time. Whether we ended up converting the 40 or 50 or a small fraction or most of them, it was time to draw the line in the sand and just finish up. So that would have put us, we did first close in November of 20, and then we set the final close date for, I believe, November of 21. And then we had a couple stragglers that, like big checks that had to finalize some stuff. So we ended up pulling them in December, and the official final close date was in December. But we communicated to everyone, final close in November. And so that kind of was a motivating factor, even though we had flexibility to stretch a couple weeks.
Mm-hmm. Yeah, we recently just announced the fund close. So despite it being officially closed 5 months ago or so, we recently announced we're a little over a third of the way through deployment. I'd be curious if you can provide maybe a behind the curtain look at the portfolio as it's shaking up today. I mean, we have seen a lot of momentum rounds. We've seen a lot of hype rounds get done over the past couple of years. I'd be curious to just hear you speak to how the portfolio is shaping up and what we're seeing today as a firm, given the current environment and how it's been affecting the portfolio.
Yeah, it's a good question. There's a lot. The public markets have corrected. And there are a lot of VCs going through some challenges at the moment. it's interesting because you and I, we do a lot of networking as part of the job with co-investors, whether they be at seed or Series A. And there's a lot of folks that are writing down their portfolios, variety of investments, right? So these are investments that were made where the companies have to grow into those valuations, right? In some cases, these are businesses that haven't launched a product yet, and they're raising at really, really high seed valuations. That's not what we do. I mean, that's fundamentally the opposite of what we do. We don't do hype rounds. We don't do momentum rounds. Everything we do is, not flashy and needs more traction to justify, the price. And so our entry point is, quite low on a relative basis from a valuation standpoint. Our ownership is relatively high compared to most of our peers. And our startups tend not to raise any rounds on hype and momentum. We see momentum rounds happening all the time where VCs keep piling on and, safes on safes and different tranches at different caps. And I don't know if that's a luxury or a curse, but during, the bull market, it felt like a curse because we didn't get that benefit in the portfolio. We couldn't go to LPs and say, oh my gosh, look at all these, frothy written up startups. But the advantage is that every markup we do have is earned, right? It's real progress. It's real traction. These founders are not raising on the team profile and a killer deck, right? And a big idea. So the great news is we haven't had to write down anything. We just had another Series A close, at a really tough time from a market standpoint. And it's, I think, 55 million posts, something like that. Investment we did probably 8 months ago. And, there was an opportunity for those VCs to adjust the valuation down. I think the funny thing is they were getting more interest, from the coast and probably could have gotten a higher price. So yes, the nice thing about the position we're in is that we don't have to write anything down at this point. And I feel, great about the portfolio. You're the one who actually recently ran the stats on portfolio construction and where we're at. So you want to give the report on how we're doing?
From an ownership perspective or any particular metrics you want me to hit on?
Yeah, give us the highlights, amount deployed and ownership, average entry.
Yeah, we are 46% deployed at an average ownership position of 13.8%. And that's across 16 investments with an average entry post money of 7.3. So pretty good. And that's in.
So that includes the 4 that are in closing?
Yeah, that includes the 4 that are in closing. And that's with an average check size of $930K.
There we go. That's the model, right? Make a promise to LPs. You got to be flexible, but you got to fulfill your obligation. We're trying to do, deals off the coast at good prices that are really strong deals that are going to mark up quick. And we have material ownership. It's a privilege to have this team and be able to execute on the vision. And I think we need to do more of it, right? Let's stick to our knitting and let's produce some really good returns.
Yeah.
There's a lot of returns to be made in software out there. I know Web3 is sexy and the metaverse and all this stuff, but there's a lot of money to be lost there. Not that there's not a lot of money to be made, but there's a lot of money to be lost. And B2B SaaS is still, it feels like inning number 3 to me.
I was just going to say
that. It does not feel like.
It always amazes me when we're speaking to some of these founders in these legacy spaces and hearing the processes and the workflows that are still on spreadsheets. And how disjointed these workflows are, the siloing of data. It's crazy. Again, probably stories for another time, but it's very eye-opening. And there are huge markets out there that are still relatively low-hanging fruit. And yeah, I'm more comfortable placing placing my bets there. But we'll see.
We'll see. Web3 is great. Maybe we should start looking at Web4, Nate. I don't know.
Yeah, I saw Rami actually posted something about that, which is funny.
Yeah, we were just chatting this morning.
Okay, I figured. I saw him tag you in it. Well, that's a good segue, I guess, into talking about what the future looks like. So how has Fund 2 laid the footwork for what will be Fund 3 before too long here?
As you say that, this is a Fund 1 company, but I'm just reading TripScout announced their $10 million Series A, led by Accomplice. Amazing. Just announced it as we're speaking. Yeah, so that's Fund 1. How does Fund 2 lay the groundwork? Well, we got to keep doing great deals. We got to keep getting these deals marked up on fundamental, true progress with, amazing leaders that just have this crazy momentum and build, multi-billion-dollar companies. And I think if we do that, we can prove the selection piece in a leadership capacity, right? There's a lot of VCs out there that start as co-investors. It's the most natural place to start because it's, smaller checks. And it's easier to kind of lean on and leverage the diligence of other VCs and kind of choose from a basket of venture fundable companies, as opposed to choosing from a basket of every company out there that may or may not be, venture fundable. So we got to continue to prove the track record, prove that we can select, and prove that we can select as a lead investor, that's doing their own diligence, with most of these companies never having raised venture capital before, right? So it's a risky proposition, and we got to continue to prove this ownership. I think you said our average ownership and entry is 13.8. Pretty good. I think our target is 12.5 to 15%. So it's nice that we've been able to maintain that in a bull market that was getting out of control, right? Many of the deals we would look at that would be priced at 6 posts were at 12. And many of the deals we would look at that were often priced at 12 posts would be, 20, 25. And so those seem to be coming down. Anecdotally, I'm seeing more rational pricing. So I think if we continue to do that, we can raise a fund that helps us prove kind of the third major test, which is more ownership at exit, which is how do we put together a really thoughtful reserve strategy and make good decisions, on the follow-on investing. Institutional LPs are really interested in that. The last call I had with a prominent institution out east, him, he was like, which SPVs are you doing and which ones aren't you doing? Because right now, SPV is kind of the only method we have for reserves. And he's really interested to talk about the ones we're not doing, right? There needs to be some decision-making around that. You shouldn't just, deploy for every up round you get. You need to show them that you know how to jam your winners, really. So that will be the next big test. I think Fund 3, looks more like $100 to $150 million fund. We'll see where the market's at that point. But that allows us to once again do the proper diversification in the ownership at entry, but then also have that complementary, 1-to-1 reserve ratio so that we can maintain some of these positions in the best performing companies.
Mm-hmm. It's an exciting future. Well, to wrap up here, Nick, what would you tell to any prospective founder listening to this episode on whether or not to reach out to NewStack? Or what would you say to a prospective founder that's listening to the show?
Look, if you're an outsider, if you're irreverent, if you got that chip on your shoulder, if failure is not a part of your vocabulary and you're hell-bent on building a category-defining B2B SaaS company between the coasts, we would love to be your partner, and we'll help amplify that, and we won't get in your way. We're not meddlers. We're not going to ask you for reports and stats every month. We're going to try and figure out, the areas where we can provide the most value and amplify the efforts that will be helpful to the business, namely on the capital side, and make sure that we have a really competitive Tier 1 Series A. So yeah, if the mindset resonates and you're listening to this, you know who you are.
There you go. Well, this was a lot of fun. I think we might have to do another episode where we're doing a deep dive on some of the war stories that we've had. But this was a great look behind what we've been up to over the past couple of years and some of the trials and tribulations.
Let's do it. Every 6 to 12 months we can do a recap, and we'll get some of your thoughts on it too, because we go through a lot of the same stuff, but I'm sure we see different aspects of it.
Definitely. Well, thanks for joining.
Thanks, Nate. Appreciate it, man. And good luck. I know you've got some hosting coming up with some really prominent LPs and some folks that you've built great relationships with. So best of luck with the hosting duties on TFR, and really excited to kind of pass the mic over to you.
I'm excited to be a part of it. Probably the first time of many times hearing my voice for the audience. So hopefully they're not sick of me already.
Awesome, Nate.
Right,
thank you, sir.
Take care.
That will wrap up today's episode. Thanks for joining us here on the show. And if you'd like to get involved further, you can join our investment group for free on AngelList. Head over to angel.co and search for New Stack Ventures. There you can back the syndicate to see our deal flow, see how we choose startups to invest in, and read our thesis on investment in each startup we choose. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for joining us.
Thank you.